Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Steve Mnuchin is apparently targeting a purchase of TikTok from its Chinese parent company. This comes a day after House lawmakers passed a bipartisan bill that would ban the widely popular social media app in the U.S. Quite interesting, particularly after he led that buyout of NYCB.
I know, and I think what's even more interesting about it is because there was that whole issue with NYCB earlier. It caused a lot of concern about regional banking. A lot of concern about TikTok in the minds of teenagers all across the country.
And politicians. So let's go to Dan Ives. He joins us, managing director and senior equity analyst over at Wedbush Securities. He always has opinions about these things. Hey, Dan, I guess it's twofold. What do you think about Mnuchin leading a group of investors to buy TikTok? Let's just start there.
He's going to join the long list, right? I mean, others haven't talked, but if you look strategic, financial, you're going to have a long list of buyers from big tech as well as outside looking to get TikTok because it's a unique golden asset that no one ever thought would become available. We still believe only a 25% chance this ban actually happened.
So what's going to be the big sticking point for that kind of a bet? Is it the algorithm?
It's all about the algorithm. The source code is not going to leave. ByteDance in China are not going to allow the source code and the algorithm to go to a U.S. company. And that's buying an F1 car without the engine. That's the fundamental issue here, is that because of the source code, it makes this extremely complex. The value is vastly different without the source code.
Mm-hmm. Well, then here's my question in terms of what the government will allow. It's like, will the government like a Mnuchin-led investor takeover? Will the government like a Netflix or a Meta or another social media company buying TikTok? Like, if you divest, like they have to be okay with who's going to buy it. What do you think?
The devil's in the details, right? I mean, the problem is, look, this is all a third rail issue. It's great theater in D.C. in front of the microphones. The reality is, the selling and ban of TikTok, first, besides First Amendment, what could happen to other social media, there's a huge ripple effect, the negative retaliatory from China, as well as ultimately, how could you sell this without the source code? And ByteDance in Beijing are not going to allow source code to be sold. And that's the issue for Senate. I mean, does Schumer even let this get on the floor? That's going to be the problem. It's very good for grandstanding, but the reality of it is very complex.
Mm-hmm. I mean, and you add to that Congress really just has not done well in the past of turning denunciations of these perceived tech abuses into law. I mean, you think about things about like protecting children online, antitrust authority, data privacy. This is not something that has come into really forceful law. So, I mean, there's a chance this might just all fall apart anyway.
That's why it goes back, like all of the work we've done, 25% chance a ban actually happens. Because to Alex, like to your point, okay, so now a ban happens, the 25% chance. How do you sell it? So you're forcing them to sell. They don't have to sell without source code. Then who's going to buy it? Mm-hmm. And then it comes down to, okay, so now let's say it gets sold to Microsoft, to Oracle. Then is there antitrust issues from a government perspective? The problem is you can't put genie back in the bottle. This is going to have huge complications because TikTok, as well as the precedent, and even the spider web in terms of how it gets sold.
How much do you think TikTok's worth? Like, let's just game it out.
100 billion with the source code. Without the source code, 30 to 40 billion.
Wow. That is a big, 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 big difference. So what are you watching next for it then? Like, what's the next trigger point for you?
Well, I think now the soap opera, we'll see that in the 202 area code. Does it actually get to the Senate floor? What negotiations go behind the scenes? You have 150 million users. So, you're in election year 2. So it goes back to that third rail issue, voting down TikTok as a ban, not good for the 18 to 24-year-old vote. So we got to see how this all plays out. Obviously, Trump on one side, Biden on the other in terms of TikTok ban. Look, Mnuchin, that's the first shot across the bow in terms of, looking for, potential to line up as buyers. Others are clearly behind the scenes doing the same thing, but it's all a game of high stakes poker right now playing out.
So on the assumption that somehow this algorithm, the source code, does become part of the sale, who do you think is the best strategic fit for this as a buyer?
Look, there's a better chance of me playing in March Madness next week than this being sold with source code. And that's look,
dude,
and
you
that's
never know, man. They could come knocking on your door.
Never know.
Again, 3-pointer, decent. But the point is, you never know in terms of now what Beijing and ByteDance are thinking. So now, even to just trajectory this out, let's say they do it without source code and there's buyers. The question is, where does it go? Is it big tech? Is it a consortium like a Mnuchin, other financial buyers? And this is going to be just a spiderweb of regulatory. It will go through the court system. And I think that's how this is all going to play out. Is there's a huge ripple effect, unintended consequences when you go down this path.
Before I let you go, I got to ask Tesla. We talked about it earlier in the hour after that downgrade yesterday over at Wells Fargo, saying that it's a growth company with no growth. Correct? Accurate? Not accurate?
Look, for now, clearly going through massive headwinds in China, but we've never called Tesla for the last decade in terms of the next 30 days, 60 days. On the other side, growth is still going to be massive. EV leadership, AI. That's what we continue to be bullish here. But no doubt, it is a white knuckle period that we're going through especially in China for Tesla. And that's why bears are all coming out of hibernation mode.
Yeah. So what do you think is next for them in the next two quarters or so in terms of analysts coming out with dimmer views on it?
Yeah, clearly numbers are getting cut a lot. That's getting priced in. But it comes down to they got to lay out the goalposts. Are the price cuts done? We just came back from Asia. I think 95% of price cuts are done. If they put a line in the sand, their street starts to look through second half of the year into next year. And I think then we sort of bottom out. It's also about Musk, the 25% ownership. I think at the shareholder meeting, they formally go to Texas from Delaware. That continues to also be an overhang over the stock. I think a lot of that gets resolved. We've been here before. I don't view this as really the end of the Tesla growth story.
Yeah, it's just sort of like delayed kind of thing. Hey, real quick, 20 seconds. NVIDIA headed into their GTC AI conference. What do you think?
The godfather of AI, Jensen, I think is going to show behind the curtains just what's coming. And because they're going to continue to lead the revolution. And this is not a 1999 moment. It's a 1995 moment. Get out the popcorn, parties just started.
That's why you love Dan Ives. He gives you those wonderful sound bites. Dan Ives over at Wedbush. We appreciate your time today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So one stock to watch is U.S. Steel. It's down another 1.3% today. President Biden says that U.S. Steel should stay an American-owned and operated company. This is Nippon Steel over in Japan is trying to buy the company. J.P. Morgan now saying that it is possible that Cleveland-Cliffs could rebid for U.S. Steel. So it's a lot. It's a lot happening. At the end of the day is we need the steel. We want to produce it. Prices are not that great. Therefore, the consolidation. Therefore, a backstop. Who better to talk to? Richard Burke, Bloomberg Intelligence, a senior analyst. He covers basic materials for us right here at Bloomberg. Richard, how did this whole thing, I don't want to say fall apart because it hasn't fallen apart, but what happened?
Really politics.
Oh, what? That's so weird.
If you look at it, U.S. Steel is located in Pennsylvania. Biden won Pennsylvania by a little over 80,000 votes last election, 2020. Steel union members in Pennsylvania are about 750,000 union members in Pennsylvania.
And they don't necessarily want this deal to go through.
And the union does not want the deal to go through. And you also had Trump come out saying that he would block the deal. There's 3 or 4, I'm not a election expert, but there's 3 or 4 critical states that probably will flip the election, and Pennsylvania is probably one of them.
So I guess I'm sort of wondering, knowing that that is the politics of the situation, what was the motivation to bring the deal in the first place?
The motivation is, if you look at the U.S. steel market, is actually with the Infrastructure Act and Inflation Reduction Act, is actually probably one of the higher growth steel markets across the world. And Nippon Steel has said that they want to get to 100 million tons of steel production a year. This was kind of help them along that goal.
Without them, though, could they not do it? And is it because it's just expensive to get it done, or is it because the prices are low, so their margins are not great?
Not quite following.
Oh, that if the Japanese company Nippon Steel went away, and they you need all this product here in the U.S. to help satisfy all the Infrastructure Act and the CHIPS Act. Without a buyer, why can't U.S. Steel just do it on their own?
No, U.S. Steel can't do it on their own.
They can? Okay.
And they have outlined a plan to get there, to improve their assets and build up. They're building another plant in Arkansas, Big River Steel 2, which they built. But back in August, Cliffs kind of put them in play. Cliffs came in with an offer for $35 a share, kind of put U.S. Steel, said that they had to evaluate strategic alternatives, spent a few months doing this, and then came up with where Nippon was the highest bidder.
So I guess if you've got these competing bids for it, I mean, what's the expectation for how long this can go on?
Well, it's currently under review by CFIUS, which is the Committee for Foreign Investment in the U.S. CFIUS deals with national security. So as people said, their deliberations are shrouded in secrecy. So, initially when we looked at the deal and we saw the union opposition, we said what they should do is U.S. Steel and Nippon should slow walk the deal. Slow walk the approval, get past the November 5th election, and then maybe, politicians' attentions turn elsewhere.
But is it possible that U.S. Steel says, all right, laters, and they're just going to go on their own way?
I don't think shareholders would appreciate that.
So now they're like, okay, we want to get something.
Right. I mean, the steel, the stock was trading like in the mid-20s, and you got a deal for $55 a share.
You want to take that. You want to get something.
Right.
I guess my question is, let's pretend that the Nippon deal falls through. Let's say Cleveland Cliffs comes back in and rebids, right? And the company's like, all right, I guess we're up for sale. Is the U.S. government going to like that deal? Because that's gonna be antitrust concerns.
Right. That switches from national security over to antitrust concerns. And also the other thing, one of the areas of antitrust which would come under scrutiny, U.S. Steel and Cleveland Cliffs are two of the biggest suppliers to the auto industry. So you have the auto companies, not happy with the deal there. So
to go back, though, to the politics of it, just thinking through some of the opposition to the Nippon bid, because a lot of that had to do with the objection from the steelworkers.
Right.
So if you think of an American bidder coming in, do you think that's an easier thing for steelworkers to accept?
Well, Cleveland Cliffs has a very good relationship with the Steelworkers Union. So that's why the union has been favoring Cleveland Cliffs. In fact, in the union agreements, there's a thing called right to bid, where if a company with the U.S. Steel has a contract with the steel union, gets acquired by somebody, the union has a right to bid. So in this whole escapade, the U.S. Steel Workers Union assigned their right to bid to Cliffs, so favoring Cliffs and things along those lines.
Can I just ask, what's the fear of a foreign company owning U.S. Steel? I mean, Nippon Steel is going to pack it up and move it to Japan?
Well, especially because Japan's supposed to be like a friendly country.
And it's not like they're going to raise prices to the point where they're going to shoot themselves in the foot to have sales decline. I mean, part of this is jingoistic, isn't it?
Agreed. And also, Japan is the number one foreign direct investor in the United States. U.S. has over $5 trillion of foreign direct investment. Japan accounts for 15% of it. So it's the biggest foreign direct investor in the United States. So on that, it doesn't really make sense either.
Hence, just pointing out the whole union politicking of it. Okay, so what do you think actually happens? Best guess.
Best guess, I think you got a lot of smart people at both companies. I think, like I said earlier, I would slow walk the deal and
sit tight till November something.
Get it past the elections and see what happens. You're probably going to have to pay the union a little bit more to get them on board. But Nippon Steel just cut a deal 2 to 3 days ago with the unions in Japan. So obviously they realize the worker landscape of wages are going up.
Oh, and I wonder if the financing picture will be a little bit easier if they can slow walk the deal and get it past the election, because looking at the Fed dot plot, we could have had a couple of interest rate cuts by then, so maybe it'll be a bit cheaper.
They have everything already aligned.
Mm-hmm.
Companies have, signed up to provide them the $15 billion that they'll need to buy it already.
So
the banks have.
Broadening out for a second, what is steel demand like right now, globally and in the U.S., and how are prices? Because if you want to find one ticker for steel prices, good luck. It is such a regional market. Give me the landscape.
No, steel prices are, what we had was kind of an interesting year. Usually you have steel prices at the beginning of the year increase because of seasonality. Obviously, construction's the biggest market. Summer, it's easier to do construction. Everybody's buying steel. What happened is that auto workers strike last year. Everybody held off buying steel because they thought steel prices would really go down because the auto workers strike was rumored to be prolonged. And really what happened is the auto workers strike didn't have as much effect as people thought. Mm-hmm. Everybody rushed back to the market and really pulled in pricing at the end of last year. So you had kind of that peak of pricing rather than coming in the first quarter. Actually, prices peaked back at the end of January. It looks like now they're probably hit a bottom. Both Nucor and Cliffs have come out with announcements that, $825 a ton we want and $840 respectively. So that's kind of stopped the free fall in prices. You have a lot of uncertainty.
Yeah.
What I would characterize across the world is hand-to-mouth buying. You're just buying what you need. You're not taking any speculative risk or anything like that to build up inventories.
All right, Richard, thanks a lot. We super appreciate it. Richard Berg, Bloomberg Intelligence, senior analyst on U.S. Steel.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's get to the retail sales here that disappointed. And this just goes to my point. I tell everyone I'm on a budget and no one believes me, and yet these sales prove that it's true. Just putting that out there. Joe Blanchard is president of Enterprise Client Solutions over at Advantage Solutions, and she joins us. So I'm looking at Control Group, flat for February, back out autos, back out gas, just up by 0.3. You also had January revised lower. What's the state of the economy when you look at consumption, you look at retail?
So hello, thanks for having me back. I was listening before. Happy Friday Eve. It still continues to be a struggle for consumers out there. When we look at things like in consumer packaged goods, the prices are still up 6.8% versus last year. The good news is that in the recent Advantage Outlook survey, manufacturers 50% said that they don't have plans to increase prices, but we do have a third that plan to increase prices on non-core items. So think of things like a smaller size package or a low-fat version. Where we really get concerned is with the value price brands. And so those are the lower price brands that typically compete with like a private brand. Those brands have increased their prices 1.5 points higher than a mainstream price or a premium price. And so essentially is the rising of the floor further squeezing consumers.
So it's interesting. You've got the cheaper stuff is getting more expensive, and then you've got continued shrinkflation, it sounds like. So, how much more of this can consumers take? Because, at the same time, you've got an incredibly strong job market. So something's got to give, I would have thought, at some point.
We do see a lot of give actually out there in the form of a few things. One is trade down, right, or pare down. So we see consumers, paring down, whether they're buying a used luxury car instead of a new luxury car, or they're trying to make meals at home instead of going out. And so we see a lot of shifting in that spending to lower priced things. We see consumers buying more private brand. Boy, they're having a really good day. In fact, 75% of retailers say that their number one growth strategy is private brand. We see consumers buying things on promotion. So we're definitely seeing a big shift in behavior. Promotions are a top strategy for manufacturers and for retailers, but they've got to be really careful not to sacrifice tomorrow by giving away today. And consumers are becoming more disloyal to brands because they're waiting for brands to be on sale or switching to a brand to be on sale. I mean, consumers' new loyalty is disloyalty.
That is such an interesting point because you basically described my entire shopping habit for discretionary. So I wanted to go to the point of sort of the macro and then the retail. So let's just pretend we get 3 or 4 rate cuts this year, right? Does a consumer all of a sudden go out and spend a lot? Is there pent-up demand in this area that you see?
No, I don't see the consumers going out and spending more. Consumers are going to continue to well, actually, they might tick up a little bit on the out-of-home spending. So think of things like the big ticket items like a car, a vacation, a home remodel. That might tick up a little bit, but those are such big priced items that consumers really have been paring that down or foregoing that in lieu of in-home activities, in lieu of affordable indulgences. So think of things like getting your nails done at home instead of a spa. So I could see a little bit, but not a lot.
So I guess what's next for retail? Because it doesn't sound like a particularly, enthusiastic outlook there for the consumer.
Yeah, I mean, both manufacturers and retailers are really struggling to find a path to win for both them as well as consumers. As I said up front, it's a super challenging environment. Retailers have to find the right way to promote. And when they all have the same strategy, it's hard to win. And pretty much when you talk to any company out there, they've got a plan to win in an environment that's largely going to be stable or flat to down. So they truly have to find a differentiated way to meet that consumer where they need to be met to win, whether that's a differentiated way with products, which is also pretty interesting. If you look at retailers, over 40% plan to carry less products, but higher performing retailers carry more product, which really speaks to consumers valuing choice and differentiation. So lots of different strategies. It's really going to be challenging to find the right one to win.
Yeah, I would find that to be so hard, like so much that you have to anticipate and then stock up. And then if not, you're looking at 80, 85, 90% discounts, which I love, but can't be good for an investor. Who would you say has a good strategy? Like, what's a good formula to emulate?
Right now we see consumers, I talked about consumers paring down. I think discount retailers are having a really good day, and it's making it pretty challenging for mainstream retailers. So mainstream retailers need to look at why consumers are going there. Is it purely price? Is it the ability to one-stop shop? Is it the ability to the environment of the retailer? So retailers need to look at, or is it their online strategy? So lots of different things to look at, but who's winning are largely discount retailers.
Could you give us a sense of the bigger picture here for consumers? Because, I've certainly read a lot about consumers moving away from stuff and towards experiences, but everything is so expensive right now. So, you're mentioning that it's the discounters that are winning, but that's a very, sort of concentrated area in retail, I would have thought. So, is the thought there that retail is just perhaps too big?
That retail is too big? No, I think it's more that retail is really varied. So I would say in response to your question about what does this mean for consumers behavior today is so drastically different than it used to be in 2019 in terms of, what we buy, how we buy, and when we buy. Think of online, think of discount, think of being in the home versus outside the home. So the future for consumers is that continued shift, towards more value-based living, I'd say. one thing that we talk about often is the baking aisle. In 2019 in the grocery store, that aisle gathered dust. And now it is the hot spot. Over 2020 and 2021, we actually created a lot of bakers. And today it's really one of the fastest growing aisles in the store.
I did the baking thing before, and then during the pandemic.
You were ahead of the curve.
I was ahead of the curve, says no one ever. But
what is it to bake? What is it you bake? Like a chocolate? I happen to love chocolate cakes, so.
I actually have a fantastic chocolate cake recipe that is super easy to make.
I don't want the recipe. I want the cake.
No, I'm not going to give it to you. I'll bake it at some point. But I actually do like baking like bread and croissants and things like that. But anyway, that was hard to do during the pandemic. Before we let you go, so I got to say, I go out to eat, 2 adults and a kid, and it's like $300. It's bananas. And I'm not talking like a super fancy restaurant. Like I'm talking like the neighborhood place. At what point do you think that that's going to top out, and then we're going to see people sort of readjust, and then all of a sudden the stay-at-home stuff comes back?
Yeah, I mean, right now, out-of-home food prices are higher in terms of their increases than in-home. And so it really is making it challenging for families to do more things outside the home. That has already contributed to increased in-home consumption, which will continue to grow if we continue to see the outside the home food prices elevate.
That's really interesting because I feel like restaurants are just getting so squeezed. They've got the staffing issues, they've got the food costs. And so consumers just want a break, but cooking at home has its own challenges. And you mentioning the point about food at home, and people are so pressed for time. It's kind of like one of those things. How do you trade that down?
I sometimes feel like the world that we're living in today is so circular, right? So the cost have increased everywhere, and it continues to go to be passed around, right? So restaurants are paying more for their products, for transportation and distribution of the products, for their labor, and they're having to pass as much as they can on to consumers who in turn can't really afford that and are cutting back. And so it continues to have a circular effect on the overall economy.
Well, great stuff, Jill. Really appreciate it. Thank you so much, Jill Blanchard, President of Enterprise Client Solutions for Advantage Solutions, talking about that weaker retail sales.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Blackstone President John Gray was in Rome, tough gig, attending the Bank of America Global Investor Summit conference. And here was the headline, "Time to buy real estate as prices are at bottom." He says, quote, "The perception's so negative and yet the value decline has occurred. So when you get into this bottoming period, that's when you want to move." Let's get another perspective here. Lisa Nee is managing partner and head of real estate over at Eisner Amper. She joins us here in the studio. Is that true? I mean, who's going to disagree with John Gray? Like, clearly talking your book for Blackstone, too. But prices bottom, time to buy.
Well, first of all, thank you for having me. So his perspective is correct. And so what happened when Signature Bank went out and brought its portfolio out to market, the prices were at a really good rate for people to come in and take the opportunities and go purchase all those great assets that were in that portfolio. And so he was one of the companies that went out and was looking at those portfolios. So there's plenty of opportunities for that careful investor to go out. And there is capital to go out there, whether you're saying it's a distressed asset or a really good investment. The market is set to go out and have an influx of capital within commercial real estate, whichever sector it is. So never going to disagree with him. He certainly is accurate on that one. And again, it's for that investor who's making sure that they're really doing their due diligence and their background, making sure that the interest rates and the cash flows make sense. That's always first and foremost.
I mean, I, for one, definitely would not want to disagree with him. But one question I would have is the whole reason why we're in this commercial real estate crisis is because of the shift to working from home. And so is that crisis over? I mean, it still seems to me that, personal anecdote only, but the subway isn't nearly as full as it used to be, even though it's picked up a little bit. I mean, if people are still working from home, there's still quite a lot of risk there for somebody trying to get in at these low prices.
Yeah, so real estate is cyclical. So every asset class goes through its highs and lows. It was retail. Now we're at the lows of office. We're going to see some inflections and some differentiation within multifamily as well. And when we look at what work from home concept did. I'm looking around here today and I'm seeing a great amount of activity where people are collaboration. And if you look back, I think 2 or 3 years ago, all the big tech companies said everyone gets to work from home, and they've changed their statements. They're coming and saying, we want you back 2 to 3 days a week. And when you look at an office lease, you were leasing office space for 5 days, but you're getting it for 7. And so it's just changing how you're looking at office, and looking at some of the buildings that are out there in the marketplace. Those older buildings that need some adaptive reuse, we're going to need that regardless of where we were in the cycle.
Yeah, and you think there's people out here now, you just wait till the snacks come up around 2. It's like people wait online for that stuff. So to that point, just in terms of the capital being out there, do you notice the bid ask? Like, have we resolved for that gap yet, or is that still to come?
So that it hasn't been resolved, and what's happening is because of the banks and their underwriting and regulations, they're unable to go in and provide a capital at a rate that's worthy of what what's being underwritten. So who's coming in? The rescue capital, which is people who are opportunistic. So you're going to come in as a preferred equity or a mezz lender, or even at a higher rate, and so those interest rates, if you're that really discerned investor, is going to be very good for you, but it's not going to be great for the owners, and they're not going to get their cash flow back. So the rates right now for the rescue is really, really high. So we're not at that point.
On average?
We've seen some preferred equity coming in between 18 and 20%. That's very. Remember, those are for some distressed deals that might need that rescuing, and they just don't want to give back the properties.
What's it going to take to broaden this out beyond the non-rescue deals?
What's it going to take? So we have to wait to see, as you mentioned before, what the feds are going to be doing later in the year, where interest rates are going to be, who's going to be providing that capital. Is it going to be the banks getting back into the market? So if the banks go back in and they're at a better point where we can pencil out some deals, it could just be a wait and see approach. Also, there's not a lot of trading going on, so people really don't have the true understanding what valuations are right now. So time's going to tell, and we really don't know where we're going to end up in the long term, because consumer behavior is still so different than anyone has anticipated in the past.
So let's broaden out then and talk about, say, reshoring, onshoring, nearshoring, all that stuff, and logistics. We were supposed to see like a ton of data centers built, a ton of logistics, and then a ton of factories built. Are we still seeing all of those 3 things happen?
So I love the fact that you brought up the concept nearshoring, which is now Canada and Mexico really is coming in. So it's going to really change the landscape of where those industry and those warehouses were being built. Before, they were built on the east and west coast. Now you're going to see them having to be built northern and southern, because that's where the cheaper containers are going to be able to be brought in. Because so Mexico, which was our largest importer, exporter this year, and Canada coming in. So it's going to change where those industrial cities have been historically in the U.S., and it's going to change the landscape. So once you change the north and the south with the industries, you're also, for an industrial center, multifamily is going to change. Commercial office centers are going to change there. So to really look at where we are in the region and those cycles could be really interesting when you're looking at the concept of nearshoring versus right-shoring.
It's interesting. Can we shift gears a little bit to talk to about a subject very near to my heart, which is residential real estate?
Oh, yes.
We always go there. We always go there.
Why don't you just take out an ad, looking?
She's
you're
in the
looking to
market.
buy.
She's looking to buy.
Okay.
It's not the best process.
I might have a house.
Help me out. John's got a house. Some long houses.
Supplies coming online. Okay.
It ain't cheap, though.
There you go.
So what's the outlook? What am I looking for here?
So I think you have it spot on. Is so the people who have the homes would be looking to go. We have no place to go to sell, and so for us to replace our homes there's no place for us to go at a low cost of capital, and so that's why that housing market is so difficult, and why pricing is still so high for residential, for single family homes. And if you look and you look at Biden's bill that he's proposing out there when he's talking about housing, they are very well aware that we do not have enough supply for the demand of single family homes. And so you are not alone with your frustrations, but for people who could be potential buyers, we're sitting and waiting because we don't know where our next home is going to be, and that's not helping your story at all. So I'm
getting no love on the show this morning.
She feels your pain on that.
And at 325, I think we're staying put, really.
We can't replace it. That's really what.
My mortgage is higher. No, my toll bills are higher than my mortgage.
Yeah, but that's
right
a reflection of how you feel about your toll bills.
No, it's true though.
No, I know it's true, but I also feel like you like to complain about toll bills, which is fair.
I like to complain about everything.
That's also fair. All right, Lisa, thanks a lot. Really great stuff. Definitely come back. Love that conversation. Lisa Nee, managing partner and head of real estate over at Eisner Amper.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go now to Tesla. So that stock is down by another 3%. Let me just see if I can pull up how bad it's been for Tesla, because I gotta say it has not been very good. The news from yesterday, of course, is Wells Fargo. Colin Langan says there'll be zero growth in sales volume for the EV maker this year. So can you be a company that's growth company if you have no growth in sales? And that stock has just really had a tough run of it, down 18% just so far this month. Steve Mann is Global Autos and Industrials Research Analyst. He's standing by for us. Steve, what do you think? Growth company with no growth?
Oh, I tend to be more optimistic about the company. I really like the stuff they're doing behind the scenes with AI, with full self-driving, the Optimus robot. I think the company is pretty much set up, vertically integrated to actually succeed. So I'm not as negative, but there is a valley, right, that the company's going through right now. The problem is, where is the bottom of that valley? Because prices for their cars just keeps coming down.
One of the issues that Elon Musk has faced with Tesla is what he gets out of cutting prices. And I wondered if you could talk a little bit about what you think he's going to be able to earn, if he thinks that he's going to be able to institute more, if he thinks he's going to be able to get more sales with lowering prices.
Yeah, I think so. I mean, the pricing is pretty elastic. I think he will get some sales. The question is how far and how much price cutting can he do from now on? Well, their gross margins are still in the mid-teens. They still have room. I think relative to the legacy automakers, their margins are still relatively healthy. The issue is China. China's a hyper-competitive market. Their main rival is BYD. They're continuing to cut prices. And if they do cut prices in China, they really have to do the same elsewhere in the world to eliminate the arbitrage that can actually occur if there's a price difference across the world.
So here's my question. I hear that it's not as desperate as maybe Wells Fargo was saying, but we're still looking at an estimated price to earnings multiple of 54 times. So is it worth that much based on everything we've just talked about? Do we need to re-rate that in a more significant way?
We do. I think we're in a cycle where we're going to see some re-rating. But long term, I'm really excited about is the company is actually very vertically integrated. They're actually behaving like an Apple, where they're trying to create an ecosystem. We haven't seen it yet, but it's an interesting thing. They're doing a lot of interesting things with manufacturing, with their FSD, and how it creates value for the long-term owners of the vehicle over time. And that's, I don't think the market wants to look at that right now, given the slowdown in EV sales. But again, like I said earlier, we're in that valley, and there is, I think, light at the end of the tunnel. But where are we at? Are we at the bottom of the valley? That's the main question. I don't think we're there yet.
I want to pick up on your point, that we don't think that we're there yet, because I feel like there might be more to come from analysts, potentially more people souring on Tesla. But do you agree on that, or what's your expectation for the coming quarter?
I do. If you look at consensus earning, the range is very wide. I think there's still very bullish people out there, bullish analysts out there. That's going to have to bring down earnings to a little bit more realistic to the current growth rate that we're seeing, especially in the U.S. market.
When do you think we then get to the valley, and what does the valley look like?
I think one thing that we have to keep track of, and that's what we're doing as well, is a slowdown in price cuts. We may be starting to see that at the moment because price cutting, the additional sales from price cutting is actually shrinking. That gap is shrinking. So I do see we're closer to that than maybe 6 months ago. So hopefully, by mid-year, second half of the year, we can see some relief in price cutting.
Talk a little bit about Tesla's margins, because we've got some analysis that says that Tesla aims to slash production costs by about 50%, but maybe that's going to wind up being more about like 33%. What do you think about that?
Yeah, I think their target of 50% is a stretch target, especially as they ramp up the Model 2. This is the 50% that they're referring to in cost cutting is really on their next generation of vehicles, the Model 2. And they've done a huge, significant, revolutionary change to how they built vehicles. You haven't seen that since Toyota introduced the lean manufacturing in the 1950s. So the price cutting of 50%, likely unrealistic, especially as they ramp up production in 2025 and 2026. Maybe beyond 2026, we may get to 50%. But that's a little bit far out there to really forecast.
So, Steve, I was interested in what you said about Apple in terms of sort of being all things to all people in one area, right? So Does that mean, and I know that Apple is a hardware company, but they really want to be a services company. Like they want that to take up a lot of their space in terms of earnings and their revenue, right? Makes sense.
Right.
Do you think that Tesla is going to do the same thing? Like they're going to get your solar panel, and they're going to get services from that. And I appreciate that Tesla's a little bit different. And your battery storage, and then your car. Like, is that the company it's going to be in 20 years?
If you look at all the things that they do, right? The solar panel you just mentioned, the Starlink satellite system, those all can be connected. Where, I can imagine where Tesla not only, you have the Uber or Lyft model, that robotaxi model, but these cars are actually carrying heavy, high-capacity batteries that it can be moved around, redistribute power around, and you have the Starlink system really connected to these vehicles to really manage that in a more efficient way. So, we haven't really talked about energy. We only, I think the market really are focused on the current EV sales and how are they going to roll out the full self-driving. But the long term, the next step could be managing power with these mobile batteries that are in these cars.
Can you talk a little bit more about demand for electric vehicles? And part of the thing I'm wondering about is if you see that Tesla is going to need a very particular policy environment in order to see sales continuing to pick up. And in particular, we've got the election coming up, a potential change of administration. Is there anything to think about there for what that would mean for Tesla?
I think Tesla have a unique benefit where they're actually a very global company already. Like they have a third of sales in the US, third in Asia, mostly China, and then third in Europe. So they're very diversified regionally. So I don't think they really need any specific policy push from the US. With their Model 2, their next gen vehicle coming out in 2025 and 2026, that will really resonate to a lot of the emerging markets around the world. So US is an important market, but I think their aim is really to go even more global.
Hybrids. Is hybrids going to be a consistent thorn in Tesla's side, or do we think we overcome that?
I think the world's going to see a mix of powertrain to really get to kind of net zero emissions. So I think in the US, I think plug-in hybrids will play a bigger role, potentially bigger role. But I think the rest of the world, we're going to see significant growth in Southeast Asia, continued growth in China. Europe, you're kind of between the US and Asia. I think there's still a big enough space, a big enough market. I think the pie for battery electric vehicles will continue to grow and absorb some of the newer competition that we're seeing from that Tesla is facing.
All right, Steve, we're going to leave it there. Steve Mann, Bloomberg Intelligence automotive analyst, joining us. Really good stuff. Okay, so I know you're in the market to buy a home, but what would it take for you to buy a Tesla or an EV? High bar?
I think the charging situation is just too horrible. Like, there's just not enough around anywhere in New York City. Well, no, I take that back. There's a lot in Manhattan, but you get to the outer boroughs and it gets a lot more tricky.
There is a lot coming up in Brooklyn. Like, you can see dedicated charging spots, but I'm also in Park Slope, so that would make a lot more sense. But I wonder, too, is that we put so much emphasis on the EVs and we missed the hybrid there. And I feel like we're all playing a little bit of catch up, because you can make an argument that while John Tucker waits for his hydrogen car, that, you know, a hybrid makes good sense.
Yeah, I'm not disagreeing with you. I just don't have any money because I'm spending so much on my bathroom.
Oh, yeah. Well, you've got to pick your poison, don't you?
That's true. One big purchase, you're doing the house, you're doing the bathroom.
It's an environmentally friendly bathroom.
What? It's gonna be really tough to get that fixed.
Yeah.
That's true. No floating toilets, no floating sinks. I'm really glad we worked that out.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.